Hello everyone, welcome back to Upside Down Data. Today I want to talk about backtesting our updated version of our upside downside potential indicator, our risk indicator, and what kind of returns you might have been able to get trading on it starting in late 2011. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter where we put out regular updates about our risk indicators and more. So if you're returning to the channel, you're familiar with our upside downside potential indicator, and we have this indicator for multiple different assets. I'm showing you the one for Bitcoin. That's the one I want to look at today. And you'll be familiar with how it's quite good at calling these high and low risk times in Bitcoin's price. I'm showing you here the price action of Bitcoin over time, color coded based on the output of our upside downside potential indicator. And you can see as it calls the tops very well as these bottoms, these low risk zones. So you can imagine that trading on the UDPI might be quite fruitful. But one thing that's important to show first off is that the UDPI is able to show this kind of output in real time. What I'm showing you here is a version of the model that has access to the entire history of Bitcoin. So as it's assessing risk, it already knows what's going to happen with Bitcoin. So one potential problem with that could be hindsight bias. If the indicator knows about Bitcoin's full price history, then is it just describing the past, or could it actually have done this in real time? Could it actually have identified the top when it happened? Could it actually identify these lows as they happened? So that's the first thing I want to show that the UDPI is capable of doing. So with our newer version of the UDPI, we can actually do the simulation starting in late 2011. Essentially, I'm just using kind of this first bull run and then correction into this kind of bear market, if you can call it that, as the training data. So I'm letting the model train based on that. And then I'm going to let it go and in real time try to assess risk as things go forward. So essentially the way this model is working is it's going to train on this data, and then it's going to be fed these days since one at a time. So it's going to be fed the next day, then fed the next day, then fed the next day. And for each day that it's fed, it's going to calculate its estimate of risk based on that day and every day that came before that day in Bitcoin's price history, but without any knowledge of what happens after. So blind to what happens in the future. And essentially we're just making it so it can't be reacting to hindsight bias. It can't be using hindsight bias because it doesn't know what happens in the future. All it knows is what happened on that day and every day before, but nothing after. And we're just getting the level that it would have said on that day and recording it. Getting the level it would have said the next day, recording it. And that's what these levels are. These are the levels that it would have been putting out in real time on that day. So if you had created the UDPI at the end of 2011 and then let it run, these are the exact values it would have been outputting for each and every single day. The exact values. So no hindsight's possible, as no idea about what goes next for Bitcoin. And you can see it does a really good job in real time, which is really good to see. It calls the 2013 mid-cycle top, calls this local bottom, calls this top again, calls the bottom of the bear market, calls the top in 2017, calls the bottom of the bear market in late 2018, calls the spring of 2021 as being a really high risk zone, summer being a good accumulation time, and we're back in the green again. And this is the literal values it would have been putting out in real time. And we can compare it to the model that's looking retrospectively, the model that's at the top here that has full knowledge of Bitcoin's price history. And what you can see is that, if anything, the model with only knowledge of real-time price history seems to do a clearer job, a better job of calling risk than the retrospective model. So in real time, it's giving very clear indication of high and low risk zones, just as well, if not better, than the retrospective model, which in my opinion is what you want. Who cares about what the model thinks about the past? We don't care about that. We care about what it would say in real time, because that's what we want today. We want a model today that's giving reliable output that we can trust as giving useful information. And that's what the UDPI seems to offer, that when we make it impossible for it to use hindsight bias, it's still very clearly identifying tops and bottoms in real time with no knowledge of anything that comes after. And we can see this if we just look at the raw output of the model. So the white lines are the UDPI level across time. Yellow is the price history of Bitcoin. This is the model that's done in real time. This is the model that's done looking retrospectively. So it's evaluating each day's risk with knowledge of what happens after. And you can see that this retrospective model, if anything, is doing an even clearer job of identifying risk throughout Bitcoin's price starting in late 2011 compared to this one here. And again, I want to just kind of emphasize this again. This model is capable of starting in late 2011 and then doing this. It only needs a little bit more than a year of Bitcoin's price action to train on, and it's giving super reliable risk output ever since. I think that's pretty notable. That suggests a model that's quite robust and is able to start performing quite well quite quickly. Does not need a whole lot of data to train on before it's able to start putting out this reliable output. So based on that, then we can say, okay, if this model would have been giving reliable output over this time, let's apply a trading strategy. Let's say we had this model starting late 2011 and we started trading based on it. How could we have done this? Well, there's obviously any number of different ways you could do it, right? You could do it that just every time Bitcoin, the UDPI hits a certain level, you just buy a certain amount or sell a certain amount. You could just do it, wait till -5. What I'm going to do for this simulation is just one possible type of strategy that someone could employ. I don't think this is necessarily the optimal strategy, just one strategy that someone could employ. And this is what it looks like here. So I'm calling this a weighted DCA strategy. So DCA just means averaging in over time. So like every day or every week or every month, you're just putting in some amount of money or selling some amount of the asset over time. And then here I just have different UDPI levels and what you're doing during that UDPI level and how much. So anything below 0 is a buy time, anything above 0 is a sell time, and then these are the exact values. And these percentages are either the percentage of available money you have at the time or percentage of the asset you have to sell if it's in the sell zone. And one thing I should specify is that if you ever hit -5 exactly or hit +5 exactly, you will either buy all or sell all. And then these are all in between. And I just noticed this is a typo here. This should be 4 to 4.99. So basically just anything below 5, you're doing this. And then if you hit 5, you're selling all. But that's just basically the approach. And you might say that these values look quite small, but remember this is going to be done per day. That's the way I've decided to do this, is every single day you're doing this. So this adds up very quickly. Buying 1.6% of your money, investing that every single day, that'll add up very quickly. And you'll see that in the simulation, that money will go in very quickly at these kind of levels. So, it doesn't need to be a high percent, but after several days, it's quite a bit of money you've put into the market or taken out of the market. So again, I don't think this is necessarily the optimal strategy, but just one theoretical thing someone could do, and I think just a baseline so we can just see what could you have potentially expected if you've been using the weighted DCA strategy based on the UDPI. So that's going to be our test strategy using that schedule we showed. The comparison strategy is going to be what I'm going to call a blind DCA strategy, where you're just blindly putting in $500 a day from that start point. So I'm going to be using $25,000 as kind of the overall start value. So this is a relatively aggressive DCA amount. And I'm also going to even be giving this kind of person the benefit of the doubt by saying that we're going to have both players start with $12,500 worth of Bitcoin at the start. So we're going to imagine they both have a position already in Bitcoin, and then they have, this amount of money to put into Bitcoin after that. $12,500 more they're going to put in. This person's going to use this weighted DCA strategy to figure out how to put this in. This comparison person's just going to put $500 a day of this in until they run out of money. Then they're just going to hold the Bitcoin for the rest of its entire price history. So what would have happened if we compare these strategies? So here I'm showing you with the white line here is the total value of the weighted DCA person. So this is the amount of money they have plus the value of the Bitcoin they have at that given day. And then I have this on a linear scale, and you can see already how bonkers this is, because each one of these marks here is $100 million. This is $100 million, $200 million. So you can see that the weighted DCA person trading based on the UDPI would have had over $1 billion over that 10-year period using that strategy. They would have gotten to $1.37 billion. I'll show you the exact values in a minute. $1.37 billion from 25,000. Just think about that for a second. How insane that is. Starting at 25,000, you would be a billionaire, well over a billionaire, using the UDPI. Okay, so that, I think, just on its face is quite impressive, to go from $25,000 to a billionaire in 10 years. How does that compare to this blind DCA approach, where you just kind of, have a position, aggressively acquiring more of a position, and then just holding? Well, you can see that the UDPI-based approach is blowing it out of the water, destroying it. You never would have hit $1 billion just buying and holding in that way with Bitcoin. You'd have hundreds of millions of dollars, so you wouldn't be upset by any means. But just look at the difference between these returns. Just look how discrepant this is. And we can see a little under the hood also if we overlay. What I'm showing you here in the green is the amount of cash that the weighted DCA person has over time. That's what this green line is. And so you can see that kind of going into the top here in 2017. So they actually sold out at the top. We're buying in again during the bear market, bought in all the way at the bottom of the bear market when it hit -5, taking a little bit of profits here, buying back in as the risk was lower, and then selling aggressively into the spring of 2021, buying back in the summer, and then coming back up here. And you'll see that this person actually would have more cash on hand than the entire value of this person who just bought and held Bitcoin from the start. So this person, this weighted DCA person, is sitting on more cash than this person has, safe, just sitting there, just cash on the sideline. And then they have this much more Bitcoin that they still have invested that they're then potentially going to be able to accrue more value as that goes up. And they're actually reinvesting in Bitcoin right now. You know, they would be reinvesting in Bitcoin right now because the risk has fallen back down into those green zones. So I think this is quite impressive. This is destroying that other approach. We can see 1.37 billion to 464 million, almost 3 times higher return using a UDPI-based weighted DCA approach versus this kind of buy and hold hybrid with a blind DCA approach, a relatively aggressive blind DCA approach. You can see it just well outperforms, and that's what you want to see. You want any kind of strategy you're using based on an indicator like this to blow out a buy and hold strategy, and the UDPI does that with a strategy that I don't even think is necessarily optimal. So I think that is quite impressive potentially. So I do also just want to show though, like let's say we give the benefit of the doubt to this buy and hold person. Let's say that instead of having to do any DCA at all, they just buy in at the best possible cost basis they could have gotten. So at the very beginning, at the lowest price Bitcoin is going to be at the simulation, let's just say they dumped in all 25,000, and we'll also say that the weighted DCA person had done the same thing. So they're both starting out the exact same cost basis. So that might be the most fair way of assessing these. So the exact same cost basis at the beginning, how do they compare over time? Well, you can see, again, the weighted DCA strategy blows out the buy and hold strategy. It completely destroys it. So not quite as high, so 2.61x instead of 2.95, but still blowing it out. You know, this is still phenomenal. You're still a billionaire. This person isn't. They're still, 525 million, nothing to sneeze at, but it's not 1.37 billion. You'll note that this value is actually identical to what it was in the previous simulation. The reason for that is that the UDPI hit -5 at that low level, that bottom of that kind of mini bear market between the 2011 peak going into the 2013 run. And so that would have just told this person to just buy everything. There wouldn't have been DCAing at the beginning because they would have been told, buy the UDPI, buy everything right now, get the best possible cost basis. And so that's, again, the advantage of something like the UDPI, is it tells you those points when you're going to be getting likely one of the best possible cost bases you're going to get. Whereas with this kind of a strategy, this is just luck on that person's behalf that they would happen to have bought at that point. Had they waited a month, their cost basis would have been way worse and they would have made a lot less money over time. UDPI would have been telling this person, dump it all in right now. That's what they did, and this is the kind of returns that they generated. So just to show this again, this is the kind of overall profits that would have happened. The weighted DCA based on the UDPI level, based on our risk indicator, $25,000 to $1.37 billion in a little over 10 years, end of 2011. 55K X profit, 55,000 X profit. The buy and hold strategy, so that them just, benefit of the doubt for them, giving them the best possible cost basis at the beginning of the simulation, they would have only achieved a 22,000 X profit. Still nothing to sneeze at, but still not the same. And again, one thing I want to note here is that this is all within Bitcoin, right? They're just buying and selling Bitcoin. You're ignoring the rest of the crypto market. One of the things we talk about a lot on this channel is the fact that you can use the UDPI in conjunction with UDPIs for other crypto assets. So not just the UDPI for Bitcoin, but the UDPIs for other ones like Ethereum or ADA or, name it. We have, we're monitoring well over 20 UDPIs at this point for different assets. And you'll know that during this run here, Bitcoin put in this huge run going into January. And then we had an alt season where altcoins did 10Xs, 100Xs, some of them, 15Xs. Imagine if you had taken some of this money here, let's say you're at around 400 million, 500 million. Imagine you started taking this profit out of Bitcoin and then started dumping it in some of those altcoins before they did 10x's, before they did 100x's, before they did 15x's, and then taking profits off of those as they go up in their UDPI levels and putting them into lower risk assets that then ran. You can see how you could have turned this $1.3 billion into, I don't even want to know how much money doing that. Because imagine what you could have done if you had 10x, $400 million, and then 10x that again, for example. So those are some simulations I actually want to run. I want to go back, do some real-time UDPI levels for different assets that we're monitoring throughout that time period, and then do a trading strategy like that, where you're taking profits out of Bitcoin, you're moving that into lower risk assets, and you're seeing how high you could have compounded things before the alt season had ended. And you can just imagine how insane it could have gotten. So stay tuned for that. Once I get those simulations coded and figured out, I'll be putting up more videos about those now. And I expect that this $1.3 billion will be nothing compared to what that kind of a strategy could have produced. So none of this is financial advice. You should make your own decisions. But I just think this shows the value of an indicator like the UDPI. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with UDPI, we're all going to make it.